a Forex trading fund coming out in November. We have apartment syndications all the time. We have an energy fund we launched in February, and we're going to relaunch it in October. And then we have funds that kind of pop up as we have the opportunity. So if any of those fit with you, reach out and we'll give you more information on those.
Sarah, can I ask a question?
Yeah.
Was the leveraged commodities investment different from the Forex investment coming out in November?
That is the Forex in November is a subcategory of the leveraged commodities. Yep.
Thank you.
Yeah, thank you. All right, so syndications, what is it? So the structure I'm going to show you guys is just generic, but know that I'm giving you an example with apartment buildings, but anything that says syndicate, like office park, retail park, mobile home park, storage units, they all follow this same structure. Private real estate funds, it follows the same structure. Instead of one asset, it's multiple assets. So the structure I'm going to show you, it's really important to understand as a passive investor and know that it can be applied to almost any of the passive structures on the 15 ways chart. So say we're going to purchase this apartment building for $1 million. So what do? We don't directly all have ownership in that apartment building. What we do is we create an LLC. And that LLC has different people in it, right? It has general partners, the managers who make all the decisions, and there are limited partners who make no of the decisions. So those limited partners are the investors. So a syndication simply means pooling people together and their money together in order to make a purchase. That's a syndication. So that's what we do. So we take out a loan, and then we need some down payment and some money to do the remodel. So we go out to investors and say, hey, we need about, $300,000 to make this purchase. We're going to get a loan for the rest. Who wants to join us? Maybe 3 people, each having $100,000, put some money in. We create the LLC, we divide up the ownership, and we make the purchase. That's what a syndication is, very simply put. So again, what are the roles? The roles are the general partners. So that's me and my business partners in this case. Or when you find operators out there and you're like, I really want to do storage units, you Google search, you find someone doing storage unit syndications. The operators, they're going to be the general partners. They're going to manage everything. They take all the risk. They're on the loan. They manage the property management company. The asset managers worry about all the accounting and the taxes and everything. Those are the general partners. The limited partners are you guys, the folks putting in the money, and you're not on the loan. The tenants don't know who you are. It's completely passive. And then gray is the loan. So I'm going to talk about now the capital stack. How does it work? So this represents all the money needed to make this purchase. That's what this pie is. So there's a chunk that comes from a loan. And again, we're on the loan. Investors are not on the loan, not responsible for it. The general partners put in some money. And then the green chunk is what comes from investors. So say in this example, investors put up 30% of the money in order to purchase this asset. So how does the ownership look? The ownership or the equity gets split up. Now, the example here is 70-30. Know when you're out there looking at funds and syndications, these numbers are not static. They can be different for every single offering you see. So just pay attention to what the numbers are. Sometimes it's 60-40, sometimes 90-10. So just really be clear. I will say that the larger the green piece of the pie is, it usually means the skinnier the investment. So it's counterintuitive because, so right now what you're looking at, and this is really good for you to know as you go out there and look for these investments, we're putting up 30% of the money to make the purchase. Investors get 70% ownership. So that's how the cash flow can be so great, and how when we exit, investors get 70% of the profit at exit for providing 30% of the money. So that ratio is what makes the really strong returns for investors. Now, sometimes you'll go out there and you'll see a 90-10 split, meaning investors get 90% ownership of the LLC that holds the assets. And so initially in your mind, you might think, oh, that's more ownership. That's great. But if the returns are the same, 20% annualized, 20% annualized, but if the team has to give investors 90% of profits to get to that 20% return for them, it means the deal overall is skinnier. So I love being in projects that have a 60-40 split, even 60-40 is better than 70-30. And you may think, but you get less of the profit. Yeah, but it means the deal is so juicy that the team only has to give away 60% in order to get investors to 20%. But this also means that there's more flexibility for something to go wrong and investors still to get their preferred return. So I'll give an example. I told you we have 26 properties we've acquired. Well, we had one at the exit where we gave 100% of profits to investors. Something didn't go right. And we could have stuck with the PPM and only given investors 70% of the profits and kept 30% for ourselves. But we wouldn't have got investors to that 20% ROI that we were targeting for them. So we gave away 100% of our returns. And there was so much there that it allowed us to do that. So if it had been a project that was skinnier, we wouldn't have been able to get investors their 20% annualized still. So I know that's really counterintuitive, and sometimes I explain this over and over, and it still doesn't make sense to people, but just know that 90% of profit returned to you does not mean it's a better deal for you. All right, terminology that's really important for you as you're doing due diligence on different investments out there for private investments. We already kind of talked about this, but the targeted cash on cash. So if you see 8% and it's paid quarterly, that means you'll get 2% per quarter. It doesn't mean you're going to get 8% per quarter. It means 8% per year, paid 2% per quarter. All right, targeted investor annualized return, 20%. This means everything, the capital gains, the cash flow, everything. You put it together and divide it by the number of years you're in the project. That's what an annualized return means for investors. There's another term called preferred return. If you see preferred return, it doesn't mean it's cash flow. It's different, but a lot of people get it mixed up. A preferred return means the amount of return investors get before the management team takes any profit. And so that's the closest you can get to a guaranteed return and a floor on your ROI. Investment profile. So I talked about development earlier, like hotel development. So that investment profile would be development. Value add is less risky. It means there's something there. We're going to remodel it, make it better. Another term you're going to want to know as an avid investor is accredited investor. So there are 3 ways to qualify as an accredited investor. And you only need one of them. Can I see in the chat if somebody knows those 3 ways? It's one of the 3 ways. You don't have to qualify for all 3. But can somebody put in the chat, does anyone know the definition and how to qualify? Yep, 1 million in assets outside of your home. It's actually 1 million in net worth outside of your home. So if you have $1 million of assets, but $500,000 in debt, not on your home, then your net worth is 500,000. So it's not just assets, but net worth. But if you have a loan on your house, it doesn't negate from your net worth. So anything on your home, asset or liability in your home category, doesn't count for accredited investor. Just assets and liabilities have to come out to $1 million or more outside of your home. That's one way. The second way is to have an income of 200,000 or more for the past 2 years. Perfect. And the third way is to have a joint income with your spouse of 300K or more for the past 2 years. Awesome. Yes, and then there's some other things around licenses you can get if you don't meet those other 3 criteria. So you can go on irs.gov and you can search accredited investor, and they'll list the extra licenses and stuff that you can get to be qualified. But if you answered yes to one of those three things, you're an accredited investor. It's not like a certificate or a test you need to take. If you qualify, then most investments out there are open to you. If you are not an accredited investor, you won't find those investments advertised. There's the rules. So you're going to want to find an operator who offers 506B investments and get in with them. Okay, cool. Targeted investment period. I talked about this in minimum investment. I'm going to use what's on the screen to do some financial modeling next to show you how this all works. Okay, so we're going to use a $100,000 investment as the example. And in my example, I said a 5-year hold and an 8% return. So 8% each year for 5 years. It's 40% over 5 years. So what would that be in cash flow? Because this was the cash on cash projection. So that would be $8,000 per year on your $100,000 investment. So if distributions are quarterly, you get $2,000 a quarter. If your distributions are monthly, you get $666 every month. You add that up, that's $40,000 in cash flow you've received from your investment. Then at the end of 5 years, we've done our 5-year business plan. We've increased the net operating income. It's a business, basically. You buy and sell businesses based on the net operating income. Same with syndications. There's a plan, a value add plan to increase the profits. And once those go up, the net operating income goes up. Then we sell it for a profit. Investors get 70%. So say you get a check for $60,000 of profit, of sales proceeds. And then you also get your principal returned on the back end, which you know to look out for, right? So if you, that $100,000. So if you take all the money that you received from this investment, so you have your $60K at exit, you have your $40K of cash flow, and you have your $100,000 that gets returned to you. You've turned your $100,000 into $200,000 over 5 years passively. So you have to do the due diligence and you have to file your taxes every year. But other than that, you're not on the loan, you don't manage the tenants in these type of investments. And so it's great for if you're building your portfolio for lifestyle and you want to be totally hands off. So this is how you would double your money in 5 years passively and hands off. Now you notice there's no tax taken into account. It's because it depends on how you hold this investment. So you can hold it in your IRA, you can hold it cash or in a trust. And depending on what state you're in and your income level, your cash flow is going to be taxed differently and your capital gains will be taxed differently than everyone else in this room, right? But know that what we do on our syndications is a cost segregation study on all of them. And so what that does is it creates a tax deferral element to our investments that we can pass on to investors. So what we've seen in the past with our investments is a 30 to 100% bonus depreciation passed through to investors. So this is going to be really strong in your tax strategy. So a 30% depreciation and loss passed through to investors means that your income will be taxed at $30,000 less, your passive income bucket. Well, what if you don't have $30,000 of passive income this year? Do you lose it? No, you can carry it over to next year and the next year and the next year until you use it all up. So it's a bucket you get to fill with this depreciation and loss, and you get to keep it to offset your taxes until you've used up everything in this bucket. So that's really cool. Now, say it was an energy investment. So say it was an investment in our oil fund, a diversified oil fund. The tax, the depreciation and loss in year one is 75%. So your adjusted gross income would be reduced by $75,000 in year one. But if you don't use it, say your income's only $40,000 this year, and you have a write-off of, a deferral of $75,000, you don't bank what you don't use. You don't bank that other $35,000. You have to use it this year. So there's a little bit of a difference, with the benefits, the tax benefits from these investments. So it's good to know how they work and what category of income tax you're trying to reduce, your passive or your active side, so that you can make an investment in the right way. Any questions on that before I move on?
It's Leah. Could I ask a question?
Yes, please.
Okay. So the first year, let's say, of the oil and gas fund, the 75%, off, so to speak. Is it prorated? If you join the fund in the middle of the year, is that prorated between? Is it first year based on? No, it's tax year based.
Tax year based. So if you invest January 1st or December 30th, you get the same 75%.
Wow. And
yeah,
the cost seg bonus depreciation against your passive income, I thought you had to be almost like a real estate professional to be able to deduct that kind of.
You have to be a real estate professional to take that against your adjusted gross income, your active income, but you can take it against your passive income.
Wow.
Without being a real estate professional.
Wow, that's great. Thank you.
Yeah, you're welcome. Again, talk to your CPA on your team and your tax strategist, because I don't know what state you're in, and there's all kinds of nuances. So bring that to them. And what we do with all of our offerings, we put a sample K1, a sample tax document in the investor portal. And we always say to investors, here's exactly what you're going to get as far as the tax document and the numbers. So take that to your CPA and see what benefit you can have. Because I don't want to say like, here's a benefit, and you think you can use it, but you can't for some reason or another. But it's available. It just depends on if you can use it and how you can use it. So yeah, good questions though, because I'm sure everyone else was thinking those in their mind. Thank you for asking.
Sarah, can I ask you a question about that? One
Yeah.
more. So on the hydrocarbon investment, Sharon had mentioned earlier about it converting IRA to Roth funds in the process in that investment. Can you elaborate a little bit on that briefly?
Yes, because when you do that conversion, you're welcome, Brendan. When you do that conversion, it's considered income. And Scott, I don't know if you're on here and if you have any more details on. I haven't done it personally.
Think about it like from the context of saying like you didn't pay tax on the money on the front end when you contributed to your IRA, right? So now when you're doing the conversion, what you're saying is now I'm going to claim all of that on income, because that's what that type of IRA is. The Roth is like I paid on the tax ahead of time. So you would treat it then at that point as if it was ordinary income. And so to be able to offset that ordinary income at that point, what you either need is you need some type of machinery-based depreciation to go against that ordinary type of active income, or you need to have real estate depreciation and also be able to qualify as a real estate professional. It's my understanding.
Or you can use energy to.
That's right. Yeah, it's like those machinery-based types depreciation is like the energy fund, I think, is exactly that. Fundamentally, right?
So just to clarify, so is it literally in a Roth account when you're done with that process, or is it just getting the tax write-off for your otherwise distribution tax penalty for withdrawing the money from the IRA?
Yes.
Yes. So what happens is that it's income at the moment you do the conversion from traditional to Roth. And so now it's sitting in a Roth, but now you have the tax liability. And that's where you need to then push money into the appropriate investment to be able to offset that income. Okay,
thank you.
So for instance, if you take 100 from a traditional and roll it into a Roth, then there's an amount that you're taxed on. But if you make the investment outside of your IRA, it reduces your income tax at an AGI level. So it doesn't have to be, this investment doesn't have to be held in your IRA to help with reducing the income tax on that, just to clarify.
Thank you.
Yeah, okay, you're welcome. And then I see someone asking how to obtain proof of accreditation that's required to invest in syndications and these funds. So there's a couple ways. Thank you for asking that. So we have a form. A lot of syndicators have a form, and you give it to your CPA, and your CPA says yes, or you know, if you have an attorney that knows your estate, they can say, yes, they qualify by this net worth or this income. If you don't have those people on your team to do that, there are websites out there, and most syndicators will pay for it for you. So like we have an account with Parallel Passport and an account with Verify Investor. So basically, Anthony, we would send you a link and we say, hey, here it is. You go through a process online, and there's an attorney on the back end online who verifies all your paperwork, and then they send us a certificate and send you a certificate, and we pay for the process. So those are the main ways. Cool. All right, I'm going to skip this breakout in the interest of time. Now we're going to talk about due diligence. Okay. Yeah, Anthony, if you want to just email me, yeah, I have a form and you can send it to your accountant. Cool. Okay, so evaluation, due diligence. So you have your vision, you have your goals, you've written them down, you've looked at all these 15 different types of investments that are available to help get you to your goals. You've decided what type of investments you want to do. Now you're going to go out and find the investments. There's a ton of people out there offering all these types of investments. So how do you do your due diligence when you find a project? So most likely you're going to start seeing them in an opportunity first view, meaning you're going to see someone advertising on LinkedIn, on Facebook, somewhere on Google, like, hey, we have this project you can invest in. And that's what you see first. And so usually investors, they start doing due diligence on the project first, and then they've done all this due diligence on the financials, et cetera. And then they look at the market a bit and they don't pay so much attention to the team. That is completely backwards. You always need to start with the team first. Who are the people involved? And really do solid due diligence on that, on the people on the team. And then everything else after that is, it's not irrelevant, but kind of, because as long as the people know what they're doing, they're going to pick the right market. They're going to pick the right asset. They're going to do everything right, right? So who are the people involved? So there's the sponsors, and there's often other people on the team. So you might see me talking about an opportunity, but I'm not the only one making decisions, right? There might be a co-GP team of 4 people, and those 4 people have companies behind them that have people on their teams, and all of their actions affect your investment. So it is quite thorough, and it is a big undertaking to do really thorough due diligence on teams, but it's totally worth it. Because if you talk to any VC firms, any VC investor, you know, they're not necessarily investing in that new company idea. They bet on the jockey, not the horse, right? You've heard that a ton of times. So they bet on the people and their track record in order to make a decision of who to invest with. So I'm just going to do one thing. All right, cool. So I always suggest doing really thorough due diligence on people. And I'll kind of skim through this, but like I said, there's the sponsors, there's the property management team. So like if you see an offer in from me and I say, oh, and who's managing this project? Well, it's Vicinia property management team. Well, you can do a lot of research on Vicinia, right? You can ask for their portfolio in the area, and you want to look at portfolio performance versus what's happening in the market. So if you're looking at my track record, for instance, and I say, what's a good example? If I say, okay, in the Dallas market, we have 6 properties, and those 6 properties are performing at 85% occupancy. Is that good or bad? You don't really know. You have to compare to what everything else is doing in that market. If the market is performing at 90% and my portfolio is at 85% occupancy, that's not so great. If my portfolio is at 95% occupancy and the market's at 85, it means I'm doing better than the rest of the market. So you want to ask for track records, and you want to compare it to what else is going on. Also, when you're looking at track record, you want to make sure they've exited. So if you go to sugocapital.com/portfolio, you see every single one of our properties that we currently hold and that we've exited. It shows you the market, the size of the property, how many units, the purchase price, the current value, the target returns for investors, and the actual return for investors. So when you're looking at a track record, you want to look at all those things. I'll give some examples. I had someone who wanted me to invest with them, and they said, you know, we have an average of 30% annualized return for our investors. I said, oh, that's great. How many properties have you acquired? And they said, oh, 10. And we've exited 5. I was like, oh, that's pretty good track record. Okay, cool. And so they said, you know, this is a 100-unit apartment building that we're looking to acquire next. Would you like to invest $100,000? And I said, can you send me a more specific track record, like the exact property size and location? And so here's what I found, is that those 10 properties were 4plexes and 10plexes local to where they lived. So they had great returns in that location that was close to them in that size. What they were looking to purchase next was across the country, and it was 100 units. And that is completely a different animal to manage something that large and at that distance. So I passed. So that's part of your due diligence when you look at a track record, is verifying that what they're asking you to invest in is similar to what they've had success with in the past. Now, this team could have been totally great and successful at that new venture, right? Me, I'm not that risky. So I said, call me back once you've done a few of those. And you've proved that you're also good at, you know, this size and this distance and all that kind of stuff. So a track record can be very telling. Someone just yesterday sent me a track record, and it said, I have $1.5 billion assets under management, and my personal net worth is 50 million. I said, yeah. But I want to see all of your projects that you're asset managing. How are they doing right now in Houston? So they sent me the names of the properties, and they said, they're all doing great. Like, that's not a track record. I want to see, you know, all the things that I just listed, the location, the target cash flow, the actual cash flow, the purchase price, the current valuation. That's really the information you want to review on a track record and really dig into that. And since they weren't able to provide that, I'm going to pass. I'm not going to work with them. They may be fabulous, but I don't have proof. And if they don't track things that way, that makes me a little leery, right? Like, why, if you're so great, why don't you want to show how great you are? Why don't you want to have that ready to go? And so I work with people who are like, here's the good, the bad, the ugly. So if you look on our portfolio at sugocapital.com and portfolio, you'll see some things are not that great, right? We've ran into some trouble. Given the current debt market, we have a bunch of things that are not cash flowing. We haven't had any losses for investors, but we have paused distributions. So all of that should be out there. And the operator and the people should be open to having a conversation with you about what's happened, what have they learned, all that kind of stuff. There's also another place you can look. It's called veravest.com. And that's a website that will do background checks on operators for you. So I pay to be on there. And so they've done a full background check on me and my company. And so they list me on that website as verified, clean. They check criminal, background, bankruptcies, all that kind of stuff for the team, the company, the principals. So that's going to be a really useful website for you as well if you're out there just starting to get to know companies. I also have an investor on here who did background checks on all of us herself. So you can do that too. But know that if you go to Veravest, it's done for you. A lot of people are on that already. So once you find a team that you like, you're going to want to find a market that is strong, and it may not be the market where you live. So I've given a few examples of where I live in California is not where I invest. So again, if you go to sugocapital.com/portfolio, you'll see on a map everywhere we have investment properties, very heavy in Houston and Dallas, and in the Sun Belt, nothing in California. The farthest west we went was Arizona, and we just have one out there. We're seeing how that does for us. But you want to make sure the market, these 3 things. You want to look at population, make sure it's a growing population, make sure it's a growing household count as well. So I'll give you an example of, if you just look at population of I'll just of my house and say, no, I'm going to give a different example. It's a 2-person town. There's Sarah and there's Theo, and there's a population of 2, and they're both in their own apartment. So the number of households is 2. Now, Sarah and Theo get married, they move in together, and they have 2 kids. Now the population is 4. So the population has doubled, but the number of households went from 2 to 1. So you want to look at population when you're choosing a market to invest in, but you also want to make sure you're looking at household growth. So you want to make sure the number of homes and apartments that are being rented is increasing over time. And what leads market growth usually is job growth. Job announcements. We love looking at job announcements. And if there's something like, hey, 1,000 new jobs in Decatur, Alabama, well, 1,000 new jobs means 2 years later, there's going to be 3,000 new jobs, because you need the butcher, the baker, the candlestick maker, all of the infrastructure to support those jobs. So watching those job announcements, you can get ahead of the curve, you can buy in that market, and then when it grows, your property appreciates, and you're pretty excited. Rent grows up, all that kind of good stuff. You're going to look at vacancy rates and market rents and look at the trends around those. And you want to look at those trends versus what's going on in the United States. Okay, so especially if you're looking to do a single family home rental yourself, you're really, really going to want to pay attention. Like, are the vacancy rates in New York, 20% of units are vacant, but in Dallas, 5% of units are vacant? That means people are moving from New York to Dallas, right? And so where do you want to buy rental property? Where people are going to. You can also look at all the rental companies like U-Haul and stuff. You can look at the ingress and egress numbers. And especially since COVID and all the great migration of the human population to different markets, you can really see where people are leaving and where people are going, so that you know where to have rental properties. So after you've looked at that, then you look at the property and the numbers, especially if you're looking to be a passive investor. Usually, if you've got the right people in the right market, as long as the underwriting looks good, it's probably a great thing. Let's see what's next. Now, I said all this, so I'm going to go through it quickly in the name of time. But if you guys want, as a follow-up email, I can send this to you, because a lot of people use this as the checklist. It's basically what I said verbally already. In the interest of time, I'll go through it quickly. All right, so the next step is finding the money. So you know what your goals are, you know what you want to invest in, you've done some due diligence, you know who you want to invest with, where you want to invest with, where you want to invest, what all that good stuff. So where do you find the money? There's a lot of options, so we're going to go through some of them. These are the options that you can use for the 15 ways slide that I had up at the beginning of the day. You can use all of these in all of those investments, I think, except for 1031 exchange is more selective, but all the others you can use. So let's go through what each one of them are. So cash, you know what cash is. In my savings account, I have 50K. I can go buy a single family home rental. I can throw it in a syndication and have it just in my name. So that's an option. Another option is if you have a self-directed IRA or a solo 401k. And I'd say 40 to 50% of the money invested with Sugo Capital is from self-directed IRAs and 401ks. It's a really large number. So people love growing their retirement accounts with real estate passively. And often what I find is that people have a little bit of money in a bunch of little accounts and they don't pay much attention to it. So what I'd like to give you as homework, as one of your goals on the last thing that we're going to do today, is to go look at all your IRAs and 401ks and look at how much money is in there and how are they performing. Because most of the time people do this exercise and they're like, I've got 15,000 over here, I've got 20,000 over here, I got 50,000 over there, but you're not really paying attention to them because they're kind of annoying. They're just like all over the place, not enough to do much with. And so if you take that and you roll that all into one IRA and it's self-directed, and you can choose anything on that 15 ways chart and put your money into it and grow it the way you want to. If you condense it, you'll pay more attention to it and you'll manage it better for yourself according to your goals. So I really encourage you to do that. And if you have the option of doing a solo 401k, I suggest that over a self-directed IRA because you'll have lower taxes in your solo 401k if you're investing in leveraged investments like real estate or companies that hold leverage. So I did this exercise with my mom yesterday, actually, is we went over with her wealth advisor at Wells Fargo. Here's all the accounts. She has half of her net worth with me, half of it with Wells Fargo and public commodities. So we went through, what are they actually earning? Do you need to adjust the strategy? Is negative 20% what you're seeing? Adjust your strategy. Is 5% annualized for the last 12 years what you're seeing? Maybe adjust your strategy. The things that I showed on that 15 ways chart, almost all of them had double-digit annualized returns. So if your IRA and 401k are not consistently on average across their lifespan earning double-digit returns, I suggest you go back, do some research, reinvest them in something else. Okay, cash value life insurance or lines of credit. So especially with high cash flowing investments, I think it's really fun to take out lines of credit and reinvest them and take advantage of the arbitrage. So you have to time this one right. I'll give an example of a line of credit. So if you have a real estate portfolio, you borrow a $300,000 line of credit against some of that real estate at, it used to be 3%, maybe today it's at 6%, but you reinvested in something that gets 12%. Okay, so now there's an arbitrage. You're earning 6% on $300,000 of borrowed money. I'm oversimplifying the math, and we'll do some more in a bit. But as long as it's a strong investment, this is what people do to really build their wealth, build their cash flow, and not having debt. I was talking to my brother about this last night. He's like, I don't want any debt. And I was like, well, that's fine. But then you're going to stay this big. People who get really big with their net worth, they build it with debt. They leverage and build, leverage and build. Rich Dad, Poor Dad, that book, read it. If you're afraid of debt, it's a really good, clear look at how it's really beneficial as long as it's good debt, not consumer debt. Cash value life insurance is my favorite line of credit to suggest because it's so flexible on the payback. So if you get a line of credit from a bank and they want their payment on the first of the month, you have to give that payment on the first of the month. So if you're in an investment that stops distributions, that monthly payment has to come out of your pocket. So there is a risk to this strategy. However, if you've borrowed from your whole life insurance policy, you don't have to pay it back that strictly. You can even wait for 5 years and then pay back that line of credit once you exit the investment. So that one is the most forgiving, and a lot of our investors do that. If they have a whole life insurance policy, they can borrow against it, reinvest it, and take advantage of the arbitrage. A 1031 exchange. So we also have a lot of investors who are getting to that point where they have 20 single family home rentals and they're like, this is way more work than I want it to be. I want to sell all of this and 1031 exchange into a passive investment. So with most of our syndications, you can do that. And you can roll it over and be part owner in the apartment building as a tenant in common. And then we wrap an asset management agreement over it saying, hey, you're passive, we're managing it. So you get that direct ownership so that the IRS allows you to do your 1031 exchange, but then we still manage it and you get to be passive. So that's pretty cool as well, a cool option. And then actually, let me just go back to this chart. So one thing that's not on here, are LLCs and trusts and nonprofits. So pretty much any entity, that's not going to be where you're going to find the money, but know that you can invest in almost all those investments that were on the 15 ways slide. Almost all of those you can invest with an LLC, a holding company, a trust, nonprofit. So that's an available way to hold them all. And so when you talk to your extended team with Scott's company, and they can advise you on what's the best way to structure the ownership. So this is where you might find the money, but then how you hold them, the ownership, you're going to want to talk to an asset protection person around that structure. All right, I think up next is, all right, this is what we've got so far. So we talked in the beginning, Scott and I, about paying attention to who you watch, because what do the wealthy do? They earn more, but they don't just think about earning more. You know, active income, investment income, they focus on that. They also focus on keeping more and growing more of it. So that's with tax strategy, asset protection, all that good stuff. So make sure you take everything that you've learned from me and then review it with someone who knows your tax situation and your asset protection, your structure situation, so that you can accomplish all three of these things with the decisions you start making today. All right, I'm going to check and see in the chat, does anyone have any questions before I jump into the next section? All right. All right, no questions? All right, I will continue then. All right, so the next section may rub you the wrong way. Some people get really cringy during this section. Some people get really excited about this section. So I get really excited about this section because this is how I've done stuff like creating additional streams of passive income in order to cash flow different areas of my life. Okay, so I use debt to create income streams, and that is turning debt into an asset. Taking debt and buying fancy clothes, that's not turning debt into an asset. But if you take out debt and you turn it into an income stream, cash flowing, it's the same as if you buy a single family home rental and you put 70% down, that's debt, but it's cash flowing for you. It's an asset, right? So how do you really maximize that? That's what we're going to talk about today. All right, so in this example, I'm going to use the cash value life insurance example. So you have a cash value life insurance, a whole life insurance policy, and you borrow $100,000 from it in order to make an investment. And say there's a yearly interest rate of 5%. I think right now, last week, someone who does this told me it's more like 5.5% right now, but we'll use 5 because it's easier math. So what do you have to pay if you borrow it and you have to pay 5% a year? Well, just looking in the chat. So this is overly simplified. If you want to use this strategy, definitely do it in a spreadsheet with your real numbers. So get the real, you know, monthly or yearly payments that you're going to have to pay when taking out a line of credit and put it into a spreadsheet. But this is what it looks like, very, very simplified. Okay, so you have to pay 5% a year. It's $5,000 a year. And using that same example, you make $8,000 a year, your net cash flow, $3,000 a year. Is that really worth doing this investment? Probably not. That's not going to change your life. But what about when we exit the investment and you get that check for $60,000? So if you take the $60,000 from sales proceeds and your $15,000 from your net cash flow, then what have you done? You've turned a borrowed $100,000 into a net $75,000 for yourself in 5 years. So then that's kind of worth it, because that wasn't your money to start with. Taking out a line of credit or, you know, a loan against something, if the money works out, it might not seem like it makes a big difference on a monthly basis, but if it can make a big difference over the life of the investment, that's pretty cool, taking advantage of that arbitrage. And maybe along the way, you get a tax deferral strategy thrown in there too. That can make this 75K number even bigger. So that's one example. I'm going to use, well, this is quite outdated, right? Principal and interest at 3.5%. Well, you can't do that today, but I want to show you an example using this number so that even if this doesn't work for you today, say you're like, hey, Sarah, I tried to get a line of credit and it's coming out at like 9-10%. Great, do the math, realize it doesn't work, don't do it today. But you're in this for the long run, right? So keep an eye out. So when rates do get to a point where it makes sense mathematically for you, that you can jump in and do this strategy. So say you have a line of credit that does principal and interest payments are required. So you have $5,400 per year that you have to pay. You get $8,000 a year net cash flow. Okay, $13,000 over 5 years, not really exciting, but you still get that profit at the exit. That is exciting. You get that $60,000, you get your principal returns, you pay back that line of credit, but you get to keep the 13 of cash flow and the 60 of profit. So you get to keep 73,000 after you pay back the line of credit. Now, that's pretty cool too. So you want to play with it, put it in a spreadsheet, see what kind of numbers you get to see if it works to do this strategy today for you, given what's available to you in different lines of credit. All right. Here is going to be the last example of turning debt into an asset. And this one is, I'm going to explain it. This is basically a different way to look at ROI, your return on your investment. So say you buy a single family home rental, you purchase it for all cash, and say you buy it for $100,000 cash. Oh, hi, James. And you rent it out for $12,000 a year. It's been some time, so now the current value is $200,000. What is your return on investment? Would you say it's 12% or 6%? Can you go ahead and put that in the chat? I want to see what you guys think. Is your return on investment 12% or 6% if you're getting $12,000 a year on a purchase you made for $100,000? All right, we got 12 from Mike. Hi, Mike. Anyone else have a guess? 12%. Anyone else have a guess? It's kind of a trick question because your cash on cash is 12%. You put in $100,000 and you're getting $12,000 a year. So you might be thinking, I'm getting 12% cash on cash. That's really good, right? But if you look at it as a return on your current value, so if the actual value of the asset is $200,000 and you're getting $12,000 a year, then your return on assets is 6%. And so I like to encourage people, especially if you have investment holdings that you've held for a while and they've appreciated, I encourage people to look at the return on asset. So in this case, the return on the asset would be 6%. If the current value is $200,000. Now I'm grossly simplifying this and ignoring all kinds of nuances of, taxes, etc. But it's just to prove an example, right? A theory or concept. So take a look at your assets, your portfolio, your single family home rentals, and take a look at the current value. Take the cash flow that you receive from that asset and divide it by its current value. That's going to give you the return on asset. Now, if that's not double digit, I encourage you to do some other things. So what are the other things that I would suggest? All right. So one option is that you could take out a mortgage on that. So if the current value is $200,000, you could take out a $160,000 mortgage, a cash out refinance. And you could take that and you could invest it in another asset class that's cash flowing 12%, another passive investment. So now 12% of 160,000, I'm going to go kind of fast, but I'm going to try to make it slow enough that it sinks in. So 12% of 160,000 is $19,000 a year. But you have a debt service for that mortgage. So say it's $9,000 per year. So you've netted an additional $10,000 a year by taking money out of this asset and investing it over here. So now you have your $10,000 from this new investment, plus your $12,000 from the rental on this house. So now you are receiving $22,000 per year. So now your return on asset is 11%. $22,000 divided by $200,000 is where the 11% comes from. So you have increased your return on asset from 6% to 11% by borrowing against one asset and investing in another asset. So that's an example of turning debt into an asset. What are some other things that you can do? Same property, same taking out a mortgage at the same amount, but instead of investing it into some commodities trading thing that gets you 12%, you purchase a second house, a second rental, and the rent is $19,000 per year. I'm just using the same numbers to make it easy. It's 12% just like this one. So 19%, $19,000 per year is the rent you get from house number 2, minus the debt service. So you keep a net of 10K. Okay, so that's pretty similar. You get that ROA up to 11%. It's a little more hands-on, but you might have some tax advantages. So you could do a cost seg study if it's worth it on this size rental. You can take expenses. So this might be good for someone who's trying to do something with a tax strategy, a tax play, even though the straight numbers are the same. So this is an example of how really paying attention to tax can help you make different decisions around your investments. All right, so what's another option? What else could you do? Well, you could sell it for $200,000. Now, of course, there's going to be broker fees. The number will be a little bit different, but for easy math, we're going to say you get to keep all $200,000. So say you invest that in an energy fund, which allows you to offset your capital gains that you had on that. And say you get $16,000 a year from that energy fund. That's $80K of cash flow over 5 years. Then there's some gain at sale. I'm skipping through the math, but you can basically plug in any investment you're looking at and take a look at, hey, if I sell this for $200,000 and I invest it in investment C, what will that turn into? So in this case, I used all the numbers from the energy fund, and it would come out to a 20% return on assets. Syndications are a 20% annualized return on average. So taking a look at that, I hope it kind of opens the option of, hey, I've been sitting on this home that I've been building equity in, and I'm getting 6% return on my asset. I can either leverage it and increase my return on asset, or I can sell it and invest in something else, use the tax deferral strategies from the investment to offset my capital gains and get a higher return on that $200,000. So it can get a little more complicated, but I really encourage you to get creative, pull out a spreadsheet and take a work and work on this. So comparison, do nothing. You're at 6%, like I said. Then we had option A, B, and C. And for C, again, just plug in any investment you're looking to do and do the math for yourself. So in this case, you do nothing, you get a 6% return on asset. Option A, B, and C all give you a higher return on asset. In some cases, close to doubling it. In some cases, tripling it, quadrupling it. So you're here to build wealth, Wealth Accelerator. How do you do it faster? If you're getting single-digit returns on some of your investments, we got to switch them out. Let's get some double-digit returns for you guys. All right, so I think now we're going to do a breakout. Oh, I have one more. Actually, I'll pause this one. Can we do a breakout now? I would love it if everyone talked about their assets and what return on asset they're getting. Because if some of you are getting a 20% return on asset and some of you are getting a 3% return on asset, I want you right now to go ahead and jump into breakout rooms and discuss what are those people doing who are getting the 20%, right? And those of you who are getting 3%, is there a way you can shift your strategy to get closer to that 20%? Jonathan, great comment. He said, but each option isn't without risk. Totally. It was very, very oversimplified. Very oversimplified. So I didn't include risk. Let's see, Brandon is also saying, is there a strategy to get out of a syndication into an uprate? I don't know what an uprate is. So sorry, I can't help with that. All right, any other questions before you guys? Oh, I see some comments. All right, Joe is asking, how does ROI compare to return on asset? So ROI is really once you exit something. And so return on asset is why you're still owning it. That's kind of the main difference. And I kind of made this up. The return on asset, it's not like an official, it's not an official thing you can look up in Investopedia. Well, let's see what Scott says. Scott says ROI is the return on your cash invested. Yep, the cash on cash. Return on asset is how the asset itself performs. Yep, also known as cap rate. Yep, perfect. Thank you. All right, cool. All right, I would love some help getting folks into breakout rooms, Tammy. So let's just do 5 minutes because we have some more stuff to go over. But I want everyone to compare what their numbers are. So not your numbers like, oh, I invested $1 million in this, but what is the return on asset that you're getting? What are your best of and worst of, and share that with each other. Because it could be something I had on the screen today. It could be something totally different, right? And so I want you to benefit from talking to other people and what are their highest and lowest return on assets in their portfolio right now. All right, Tammy, go for it.
All right.
So smaller groups.
5 minutes.
Yeah.
All right. Awesome. Thank you. All right, Ken, go ahead. Thank you so much, Ken.